All right, good morning, everyone. Thank you for taking time out of your day to join us for this Insights call. My name is Matt Venker. I'm a portfolio manager with FNBO. I help clients manage their investments and help plan for the future. And joining me today is Kurt Spieler, who is our Chief Investment Officer. And we're going to spend a little time talking about our outlook for 2021. Not necessarily predicting what's going to happen, but talking to you about what might develop during the year. And we have a lot to talk about, so I'll let Kurt get started.
Good morning, everyone. Thank you for attending today's 2021 Outlook. I look forward to the conversation and the dialogue. How our 2021 Outlook is different, and should I say better, is we don't just cover the economy and the markets, we also provide you with some information in terms of topics that we find interesting. This year we selected behavioral finance as a topic. Is something that I've been particularly interested in. It is an integral part of how we provide advice. And at a high level, what behavioral finance is it outlines theories based on economics, finance, and psychology in terms of the decision-making process for individuals. In talking with the business leaders of the organization, they found some commonalities, not just investment terminology, in terms of that decision-making process and the influence. To start, let's review a few behavioral biases that we see are common examples. Some that I'm personally, guard against. Overconfidence, perhaps maybe this isn't the best 2021 outlook, but really from an investments perspective, I'd point to hindsight. So it's always very easy to determine after the fact why the market went up or down, and what were you thinking at that time frame. So even as us as professional investors, trying to make sure that we're objective and not letting our prior experiences impact our decision-making process. You may recognize some of these that you yourself, whether it's within the business or within the economic standpoint, that you see in terms of behavioral biases. This year, we've chosen to talk about two, loss aversion, as well as herd mentality. First of all, loss aversion, in essence, there's been many studies that state that people feel twice as bad about losing money. So if you make an investment and you're down 20%, they will feel bigger pain or twice as bad as compared if the strategy worked and you had a gain in that investment. So if the investment was up 20%, you'll receive pleasure, but not as much as you do. Where we think this leads to in general is from an investment perspective, it's underinvesting. So we see clients with a lot of cash on the sidelines in today's world earning 0%, or not investing for the long term, so not understanding the investment implications. From a business perspective, you may be familiar. It may be that loss aversion leads you from making or prevents you from making an acquisition or expanding your business standpoint. So it can also have an impact in terms of how leaders manage their portfolios. Looking to herd mentality, which is a little bit different than the herd immunity that we're hearing today. This just shows the cycle of investments and emotions that people experience as there is a tendency to follow trends. So if you look at it from this perspective, or from an investment standpoint, there are times when people are euphoric and as well as panicking, that move from fear to greed and back, occurs frequently within the market standpoint. From a business standpoint, this could mean overinvesting when times are good, so extrapolating out the recent trends, and underinvesting, it could mean when times are bad from that perspective. I think this chart is also appropriate from an economic cycle. In fact, I would say with the recent changes in the global pandemic that we've gone through this entire cycle within a year. So to a certain extent, what we've seen that's taken years in the past as you cycle through these emotions and the economic cycle, at least here lately, has been compressed and could be from a year standpoint. Speaking of the economy, this is an economic outlook. The biggest point has been COVID-19, government responses to it. If you look at it at a high level, governments, including the U.S. government, as well as central banks, have spent trillions of dollars to limit the downside. We're going to start with the central banks. This chart shows the Federal Reserve, Bank of Japan, European Central Bank. The size of their balance sheet for the Federal Reserve was 3.1 trillion or has increased from a little over 4 trillion to a little over 7 trillion. So I always think this is one of our more understated charts in that combining the three largest central banks, we're talking about $8 trillion, and it looks like a little bump in the green line. It has had an impact in terms of helping from the economy. So in addition to the expansion of the balance sheets, we've seen central banks lower their interest rates, such as the Fed, to 0%. It has been a higher stock and bond market from that perspective, but also there has been some positive economic points. So zero interest rates from the Fed have helped interest rate sensitive sectors such as housing, autos. We've also seen Congress enact a number of stimulus packages and recently signed another round of $900 billion going into the market. That's had an impact on the PPP, for example, that you may be aware of. The bank just opened the second round of PPP here on Tuesday, so that has helped support businesses. And then the checks that have been set to low-income individuals, as well as the extension in unemployment insurance benefits, have also been helpful from an economic standpoint. With that, I wanted to turn to our first poll. And the question for you is, do you feel the economy will fare better or worse? So are all these stimulus activities from the federal government and Federal Reserve working?
Again, just click your answer and then click submit, and we'll review these at the end of the discussion.
Consensus expectations, let's talk a little bit about last year. At the beginning of last year, the world economy was expected to grow around 3.7%. As you can see from this table, we're now expecting negative 3.7%. So nobody obviously expected COVID-19 to hit. You can see the variations by region. Asia in general and China were more resilient than last year. But by and large, economists are fairly positive for growth expectations as we enter 2021. So for the world, 5.2% GDP growth. For the U.S., a little bit above 4% growth is expected, from that standpoint. How we look at it is a little bit pre-vaccine versus post-vaccine. So we think the first half of the year will be a little bit on the weak side. From that standpoint, as governments are continuing to shut down their economy or having some form of temporary shutdowns in place. Today's consumption number is a little bit on the weak side, for example, so a little bit of a pause in the economic growth as we go through the winter season. But we also believe that there is pent-up demand in the second half of the year as we get into herd immunity, hopefully through vaccines, and not more people getting the COVID-19. So that's a big piece of our forecast. So in addition to that first half, second half, there is a lot of what I would characterize as haves versus have-nots. So certain parts of the sector are doing particularly well. One is by size. So large companies in general have been resilient. So this is the Amazon, Walmarts, Targets of the world that had a strong online presence that were have stayed open, viewed as essential businesses, and they have gained market share to the detriment of some of the small businesses. What this chart shows is how many small businesses are closed as of December 30th as compared to January of last year. And you can see from here in the U.S., 30% are not are closed or not reopened since that time frame. And this does vary week to week. If you look at it, this is the primary states within FNBO's footprint. Nebraska, it's holding its businesses more open, so doing better than certainly the U.S. average as well as other states within the footprint. So we're seeing, some differences in performance in the small business world. So the last question from the polls was related to the macro. What do you think of the overall economy? Is it doing better or worse? And so we wanted to take it down because to a certain extent, large companies are different than small companies from that standpoint. So let's turn to what I call the micro poll question number 2. Is in your world or as a business owner, do you feel better or worse about we talked a little bit about the haves versus the have-nots. Part of this is how consumption has changed with the global pandemic. So changes in personal consumption here. What we've seen historically is services. This would be the travel, restaurants, leisure, type activities. From that standpoint, has historically grown pretty consistently at 4 to 5%, and you can see how that's changed here recently. So I would characterize this as the first recession, in which was, in essence, a services downturn. So people did not continue to spend in those areas. Goods is a different standpoint. So this includes durable goods, autos, furniture, electronics. It also includes food, other items, has actually rebounded and is showing better growth than over the last 5 years. And so as people's spending patterns have changed, you're seeing the goods part of the economy doing significantly better, with the services still down on a year-on-year basis. One of the beneficiaries of the zero interest rate environment I alluded to is housing. And this chart shows the U.S. residential construction index. You can see was growing quite well. Downturned actually in 2019. So we experienced a slowdown before the global pandemic, and then has accelerated here over the last few months. Now, this is partially due to the mortgage interest rates at all-time lows for much of the last 6 months. Also, supply has been low if you're looking to buy a house in the current environment from that perspective.
If I can jump in with a couple questions. Housing's been doing really well despite the deep recession we've been in. Obviously, that's due to low interest rates and lack of supply, basically. But do you think this is sustainable going into 2021 and next year as well?
Yes, I do. So we're well below levels that we were before the financial and housing crisis in 2009. So we're nowhere near 2007, 2008 levels. I refer to the low supply. And so I think there's a pretty good runway as long as interest rates stay low. There's also talk about how the work at home, as we're doing today and presenting to you virtually, was about 5% of the population pre-COVID, and there's estimates as high as 24% will be post-COVID when we get back to whatever the new normal is. I think that's probably a little bit high, but the reality is more people will be working from home. They'll want to spend on their home, upgrade, move to the suburbs. So that will also add a layer of growth through this year as well as into next year.
Well, that work from home situation has also changed the perspective on commercial real estate. How do you think that's going to fare going into this year?
Yeah, that's a little bit more nuanced, and I would say industry by industry. So with the extent of online shopping, people ordering more goods online, getting it delivered to their home, what that means is increased the need for industrial. And so, the warehouses to house the goods to make those 1 day or 2 day shipping requirements. And so you've seen a benefit there. And there's some other sectors related to cellular towers, cloud, type companies that are also performing well due to the increased need for technology. On the negative side, though, your brick and mortar, and so I guess to take a step back, these are trends that we've seen for the last 10 to 20 years, and they're accelerating in today's environment. So brick and mortar is going to be difficult. You know, that's part of the small businesses that are closed. Office, we talked about how to some level, there's going to be less people working, you know, from the office. A lot of people think commercial real estate bottoms in aggregate, the whole sector sometime this year. But the outlook, I would say, is not as positive, you know, for commercial real estate as it is for residential real estate. That does bring me to the next poll. So as business owners and employees, part of it is, are you expanding your office, warehouse, et cetera, and capabilities? But there's other consumer or capital spending plans that you may be considering. Could be equipment, technology, you know, not just office. So our third question that we're interested in getting your response, and part of why we're asking those polls is hopefully to keep you engaged, but I particularly enjoy the one-on-one conversations with business owners because we get insights from you. So what is your capital spending plan for 2021? Wanted to spend a few more minutes talking about the consumer. I would characterize this as capacity to spend, you know, from this standpoint. One of that is what's going on with the savings rate, how leveraged are individuals into the economy. The savings rate is essentially what do you have left over after buying goods and services and paying taxes. It's expressed as a percentage of disposable income. Once again, another first in the recession, in that the savings rate actually spiked during the recession. So you can see it's still at elevated levels as compared to the last 15 years. This does not reflect the additional stimulus activity that was just approved in the last few weeks. So depending on whether individuals choose to spend or save some of that is, you know, in essence, what they did last spring and early summer. But we're in good place in terms of the capacity to spend. The other aspect of that is, well, they have the income. So maybe savings rates are in good place over the last year. What is the income and consumption outlook? What this chart overall shows is disposable income has been fairly positive, still running in the 4 or 5% range here over the last couple of months. Consumption's been negative, so this in essence combines that good and services chart previously, where goods are positive and services is negative, and netting out your 2.4% down as of last month or as of November, from that perspective. So in general, we would characterize this as positive. We believe that there is a long-term close correlation between income and consumption. Invariably, what happens is if you have more income, whether it's 2 to 3%, you'll spend some of that. You may save and pay down debt, but invariably, people spend some of that additional income. So positives, I would say capacity, savings, income. The biggest concern from a consumption standpoint, in our opinion, would be the U.S. labor market. So what this chart shows over the last 5 years is the total amount of unemployed workers, which is a little about 10 million here as of November. And then the U.S. total job openings, which is a little bit above 6 million in terms of job openings. So that's, to us, the biggest concern is unemployment rate, for example, is around 6.7%. We've also seen less labor participation. So as people gravitate with the finite dynamics of working from home, supporting kids in their education, just the new dynamics that we've seen, what you've seen is labor participation going down. That would imply if it had stayed the same, the unemployment rate would have been even higher. So the fact that we don't have jobs for these people, this also goes back to the businesses and small businesses being about half of employment, being critical to that. If they don't reopen, that has an impact in terms of the total job openings and bringing that unemployment rate down.
Kurt, the jobs, the lack of jobs is certainly one risk that we see for the economy, and the economy sure looks like it's bouncing back, but Do you see any other major risks we should be looking out for?
Yeah, I think the short-term risk is still relating to COVID. Especially as we mentioned, the pause in the economy in the first half. If the vaccine rollout, which is maybe not going as smoothly as we had all had hoped, having an impact, or perhaps the efficacy goes down with the additional strains. So it's still related to, how do we get back to whatever that new normal is? We talked about here just the employment. I think that's key. The sustainable economy only happens if people are employed and in jobs. So at some point, the stimulus activities from Congress, even the Federal Reserve, is going to ebb or not be the same backstop as we're experiencing today. I would say the longer-term risk, and we'll talk about more of this here in a little bit, is just the potential for interest rates to go up. So as I mentioned, the Federal Reserve's been supportive with their lending facilities with zero interest rates, with the buy-in of Treasuries, keeping interest rates low, and that's helped from especially those interest rate sensitive sectors. But what would happen if interest rates were to rise and the Fed was not supporting the economy? Can it stand alone from that standpoint? So I would say that's the other additional, maybe more long-term risk.
Obviously, the last year has been a little bit different as far in the political environment. What, as investors, should we be looking at from the new administration now as we move forward? Obviously, there's a lot of uncertainty in regards to different policies, but what should we be concerned about as we move forward?
Yeah, we deliberately chose not to write about politics in this year's Outlook, in part a lot of uncertainty in terms of the outcome when we were putting this together, but in part, in general, we would say politics are overstated in terms of the impact on the markets as well as the impact on the economy, from that perspective. So how we think of it is not so much politics, but policy can matter. So what we're evaluating is, changes to the regulatory environment, potential changes over the next 12 months or 24 months in terms of the tax environment. So what are those policies that could impact the economy? The reason why I started with that it's a little bit overstated is, in general, those policy changes, a more difficult regulatory environment, higher taxes, are perceived as being negative by most investors, but they're typically not significant enough to, let's say, cause a recession. So you might see fractions of percent lower of growth because of those environments. So it's something that we continue to monitor. Overall, we would say a 50-50 Senate, a small majority for the Democrats in the House, the presidency. That's not a mandate for a progressive agenda. There is such a thing as moderate Republicans and moderate Democrats who actually will have a lot of power over the next 2 years. So it's something that we monitor and we evaluate, but we don't necessarily make portfolio changes. We think it's overstated from a direct impact. Markets are up as we've gone through all this turmoil, even what happened at the Capitol on January 6th. That entire week, the Senate moved to 50-50. You had an insurrection in Washington, D.C., and the stock market continued to go up because it is about the economy and company fundamentals.
I agree with that, but I know one question a lot of clients are concerned about is, in regards to policy, is the national debt and how the size of the deficits we've been writing. What's the long-term impact of that, and how can we focus our portfolios on avoiding any risks there?
Yeah, the long-term impact is it's negative. So we're passing the buck, so to speak, to our kids and grandkids from that standpoint. So we're on an unsustainable path from a deficit spending. And long-term, what you've seen with other countries that have higher levels of debt as a percentage of their economy is lower growth and lower inflation. So, no reason to invest. Governments are spending to repay their debt. Their spending on interest is not positive from an economic standpoint. The short term, we don't see a crisis unfolding. Our debt levels overall is reasonable relative to the size of the economy, maybe getting less reasonable every day. from that perspective. So we don't see a short-term risk or crisis coming, but we're on an unsustainable path. And as we get past this need to backstop, support the economy, during the global pandemic, how do we bring spending under control? To us, what we've always talked about is, debt's not a problem for the next, 10, 15, 20 years, based on the amount of spending. That time frame where it's going to become a bigger issue, maybe it's more like 5 to 10 years from that perspective. I would say a big piece of that is the interest rates. And I do have a chart here because one of the arguments for spending now is it doesn't cost much for the government to spend. What this chart shows is the yield curve from Treasury yields, 0 per 3-month, 6-month Treasury yields all the way to 10 years. 2020, every yield at the end of last year was below 1%. And then we just compared it to the curve 5 years ago and 10 years ago to show the difference in how much more lower interest rates. Obviously, if we had done this, 20, 30 years ago, you'd see even a huge spread in terms of the Treasury yield environment. How we look at this is the short term is really controlled by the Fed. So they've articulated that we're not even thinking about increasing interest rates for the next couple of years. We're going to continue to support the economy. We need employment to come down. We're not concerned about inflation. Long term, the market controls, the bond market controls and sets those long-term rates. Right now, with interest rates very low, the Federal Reserve is buying a lot of the Treasury auctions that come out, and so they have been able to talk. There's some talk about 50-year bonds, for example. One of the questions that we had for you as well is on interest rates. Where do you think they're going? The 10-year Treasury yield ended last year a little less than 1%. From that standpoint, where will they go over the next year? This is a little bit of a trick question. The overwhelming consensus is, that interest rates will rise. How can they go lower? I would say from my days in managing international money, that Japan went to 0% or actually negative 25 years ago, and have never gotten above from that perspective. So it's not, it can be below below 1%, can go negative as a lot of the world's market now. Having said that, what do we think? Well, we think interest rates are going up slightly. So maybe this goes back to the behavioral bias and following trends from that standpoint. So from our perspective, as I mentioned, long-term interest rates are based more on the market, and to a certain extent, it's what are the expected inflation expectations. So this is the 10-year. So what is inflation expected to be for Treasury inflation protection securities? You can see the range in general has been 1 to a little over 2%. The Federal Reserve's indicated their target is 2%, which is about where we are today. From that perspective, but they're willing to let recession run above 2% for a bit of time. So is inflation going to be a problem? So we expect modestly higher interest rates. We don't see inflation this year as a problem. There's a lot of excess capacity. The high unemployment, capacity utilization rates are low relative to where we historically have seen stresses of inflation. But this is one of the risks that if you do get the amount of spending that's occurring from both the Fed, from the federal government, as well as the Federal Reserve, and you get an accelerating economy, that you can soak up some of that excess capacity and create inflationary environment. The printing or the deficits are by themselves are not inflationary. What we've seen at the bank is a lot of deposits. So some of that additional money is sitting at the bank and therefore is not inflationary. We wanted to turn and spend a few minutes on our investment strategy. So what do we like? What are we implementing in client portfolios? Before we do that, we want to take a step back. What we see as key for you to succeed as investors is to basically, follow the investment principles outlined. So define those investment goals, set the asset allocation, adhere to that allocation. Don't try to market time in and out. Stick with that long-term investment portfolio so that the investors that have succeeded have those elements. We're going to spend a little bit of time talking about number 4, diversify assets. The reality is over much of the last 10 years, if you owned the FANG stocks, Facebook, Amazon, Apple, Microsoft, Netflix, Google, from that standpoint, and you own 30-year treasuries to get some diversification when we went through those choppy environments, your portfolio would have performed extremely well. In our opinion, the next 10 years is going to be different. So this is where diversification, which you could argue is not helped from a return standpoint, we believe is going to be helpful. And this is how we diversify portfolios. So asset class would be for most individuals having stocks, bonds, cash, real estate, alternatives is appropriate. Diversification by strategy. So this is within the U.S. By size, having some large cap, mid cap, small companies. By sector or style, so having some more value-oriented strategies in addition to the growth stocks in the large cap world that have been performing so well. Geographic diversification is having some international. Our focus is on international equities, not as much on the fixed income area. And then security selection could be individual stocks or individual bonds. We also utilize mutual funds and exchange-traded funds or ETFs for further diversification. Let's go to our last poll here. So what do you think? So our investment process starts with having a diversified portfolio, and then what do you like and dislike within that asset class? Do you think equities will continue to go up? So poll question 5, the S&P has obviously had 2 strong years, including last year finishing up 18%. What return do you expect? Are we going to have another good year, another extremely good year, or are we finally going to turn negative? Our answer is coming up shortly, but I wanted to put in the market landscape that we're in today. One of the things that hasn't been written about a lot has just been the resilience of company earnings, and this is the S&P 1500, so it would include U.S. large, mid, and small. The third quarter earnings, that's not on this chart, I thought was an amazing statistic. Third quarter earnings were down around 7 or 8%. If you took out energy and you took out airlines, earnings growth last quarter was actually positive, or in the third quarter. You can see from the last 12 months that earnings for the U.S. broad market was down about 16%, and 4 sectors showed positive growth, including some of those technology areas, as well as consumer staples and utilities. So more defensive areas of the marketplace plus growth showed earnings resilience. Part of the story for the next 12 months is a broad economic recovery, that 4% or so economic growth leading to 24% earnings growth. So huge recovery. It's not just the growth in defensive areas. In fact, their earnings expectations are less than the overall market, but more your cyclical area of your markets, your basic materials, your financials, your industrials. Energy, it's not a typo. When energy earnings went basically to 0, so any sort of positive earnings leads to 567% growth. But to us, it's the key. We believe the stock market in general looks at what is the expected growth from an economic perspective and what is corporate profitability. There's a high correlation to those 2 areas. So 2 positives there. We expect growth in both the economy and earnings. Probably the biggest negative would be your stock market valuations. So with the earnings being down last year and the stock market being significantly up, what we're talking about, and NTM is next 12 months earnings, is the price to earnings ratio for U.S. large caps at 22.5 times, whereas the 15-year average is 15. So fairly huge premiums. A lot of people are explaining those premiums by in low interest rate environment. You would expect higher valuations, and that's definitely the case. If you look at equities compared to bonds, they're very similarly valued, both expensive from that perspective. Also, valuations are a poor market timing indicator, but what it does mean for you as investors is your 10-year returns are likely going to be less. So the more you get today or the more you got last year from a return standpoint, it may not be for 3 or 5 or 7 years, but over the next 10 years, it will have an impact as valuations return to their average levels.
When you look at these valuations and the fact that it doesn't seem like the stock market ever wants to go down, would you consider this a bubble?
I would not consider it a bubble, but there are some signs that we're approaching it, and that's that persistency up every day, even when news flow is negative, are the volatility. There's some areas that kind of feel a little bit like a bubble. For example, there's a thing called special acquisition investment corporation, SPACs. There's 248 created. What they basically are is people giving money to organizations in the hope they buy something attractive. So they make an acquisition, by far exceeding what we've done historically. So people don't know what to buy, so they're hiring someone to find something to buy. I would cite Tesla. So I saw a statistic the other day. Tesla is now the 6th largest company in the S&P 500. That for every auto that they sell, the market cap of the company is $1.25 million for every auto, compared to General Motors, which is $9,000, market cap per car sold from that standpoint. Now, I know the bullish argument on Tesla is they're more than a car company. They have other, software and applications. So I'm not here necessarily to paint a negative picture on Tesla, just to point out that on a sales basis, on a per car basis, that you're talking about expensive valuations. Cryptocurrency, Bitcoin, so that's another area that's seeing a lot of speculative activity at this point.
And we know bonds are expensive with interest rates so low. I don't know if I consider that a bubble either, but with stocks and bonds both seemingly expensive, how do you invest in that kind of environment?
Yeah, so our conclusion is favor stocks over bonds. So bond returns with interest rates stately flat or modestly going higher, the returns are going to be close to zero in the fixed income market. There's a lot of flows still going into bond mutual funds, which I think is surprising in that you're seeing a decreased return expectation. That's been occurring for much of the last 20 or 30 years, but I'm maybe not sure investors see how low. So we still are favoring equities over bonds. These valuations keep us from being, maximum overweight or euphoric about the market. But in general, how we're looking at it is, growth in the economy, growth in earnings, and accommodative Fed historically has led to higher stocks. Maybe not as much as we've seen, certainly over the last couple of years. There's risk with that, associated with that, and that's why we would characterize it as being, somewhat overweight equities relative to bonds, but not at maximum levels. How you invest was your question, Matt. I would say we are looking at alternative investments. We have one that we've increased the allocation for. It's a mutual fund that is characterized as hedge equity. It allows or has participation in the stock market in advance, but through the use of options and futures limits the downside, especially if you have a 5 to 20% type correction. What we've seen and experienced through this fund is it has about half the volatility of the stock market, but it generates more than half the returns. And so it's attractive on a risk return basis. We've also looked at other alternatives. We have a team just focused on finding alternatives. We've added a gold ETF here at the end of the last year to get some other exposure, and we're continuing to look for how do you protect portfolios in a recessionary environment and still generate the returns that you're looking for. And so that's where we're allocating a lot of time. are we looking at Bitcoin? That was, I think, a question in advance, you know, of the conference call. The answer is, you know, we're evaluating. It's very speculative. Right now, there's not a value associated to it. It's really how much will the next person pay for your area of Bitcoin. It has also not been institutionalized, so we can't hold it as a custodian. You look at Coinbase or some of the other holders of it. There is one ETF, but it's expensive, and it's like a closed-in mutual fund in terms of, especially in environments such as today, it's trading at or can trade at significant premiums to the underlying value of assets. So the reason cryptocurrencies are going up is because governments aren't valuing their money. So when you move interest rates to zero and you run trillion-dollar-plus deficits, you're saying to the rest of the world that the U.S. dollar does not have inherently the value that it previously did. So that's leading to, because of the limited supply in cryptocurrencies such as Bitcoin, a lot of interest in that area. Probably the biggest risk that could lead to a 90-plus correction, though, is I think at some point the regulatory environment is going to change for Bitcoin, and so that could be something. So I guess I'm moving a little bit off from the answers to your questions, but that's a piece of that is how do you find alternative return streams that are not tied to the equity and bond market? How do you further diversify the portfolios? We've talked about how that's a key part of our investment principles. So how do we do more of that? So I know we have some time for some more questions, but before we go to that, Matt, do you want to kind of take over? What was the poll outcomes from a review standpoint?
Sure, thanks, Kurt. And we asked 5 questions throughout the discussion, and so let's take a look and see. Hopefully this will pop up on your screen as we put each question through. The first one we asked was, how will the broad economy fare this year? Do you think it's be better or worse or stay the same? And looks like most people think it's going to be better. And I think we tend to agree. How much better it is a big question, but I think we all think that this year will be better from an economic standpoint. There's a few people who might be concerned about it getting worse or being about what it was like last year, but I think the optimism is pretty broad overall. The next question was, how do you feel that your specific company will do this year relative to next year? And the answers are actually very similar. More than half said you'll do better this year. Some people said it'll be about the same. And about 18% said it might be a little bit worse this year. And part of that will be impacted by capital spending. So we asked how your capital spending will change this year as a result of the economy. And most people are going to stay the same. I think it's a pretty realistic expectation, not knowing what COVID's going to look like and what policy might look like. Some people will increase and some people will decrease, but most looks like they're going to stay the same as far as capital spending goes this year. Turning to the markets, we asked about what interest rates will look like. We think interest rates might gradually increase over the next couple of years, and I think most people are expecting that we'll end up with slightly higher interest rates as we move forward. 64% said 1 to 2% is where the 10-year Treasury will end up. I think it's a pretty realistic expectation over the next year. Few people said over 2%, and that might happen this year, but probably over the next couple of years, more likely. But a quarter said it might end up below 1%, which means we'll keep rates very low, and that's going to take probably some Fed intervention to make that happen. And then stocks. Whose crystal ball is most accurate? What return do you think we'll see for stocks this year? We finished up again 18% last year. So this year, the vast majority say it's going to be more of a single-digit year, somewhere between 0 and 10%. Again, given the current valuations that we talked about, that's probably realistic. A few people say maybe a loss. A few people say it's going to be another double-digit year. But I think most people are right on track. We'll probably see somewhere in the 5 to 10% range. Well, very consistent views, a lot of varied opinions out there, which is great. We appreciate you all taking your time to answer these questions. I know some of these questions might have closed a little bit early, but hopefully we got some good participation from everyone. And we do still want to take some time for questions. We still have about 10 minutes or so, if you'd like. So we'd be happy to answer any other questions that we haven't already discussed. One question we had was, if we do get GDP growth this year of, we expect maybe 4 to 6%, do you think we'll get a change in PE premiums? Do you think we'll get a reduction in the PE premiums as the economy grows? Or do you think people get more optimistic and keep bidding stocks up?
Yeah, I think my expectation would be that the PE premiums, that 22, and it's a little bit less for international and small and mid cap, will come down a little bit. So, and that's typically what you see coming out of an economic recovery. The market is a little bit pricier because earnings are suppressed, and then you get that, 24% or whatever it is. So I don't think we'll have the same valuation. So if you go back to that forecast and you expect 5% returns and a 24% year, and 2022 earnings may be, let's say it's 10%, you'll have that come down from that perspective. So as the economy normalizes, if you get that economic growth, I'd actually see, less speculation, less expensive valuations in the market. So you kind of grow into those valuations.
Exactly.
The one thing I should say that we wrote about, and I just alluded to that, is diversification obviously is a theme of our outlook this year, but looking at it, there is some opportunities in small and mid cap from, that standpoint. Less of a premium valuation, and also beneficiaries. So if the economic growth broadens out to include more sector services, for example, you may see more participation. And that was an observation I had on the polls, and I think that's true, because I think small businesses are a little bit less optimistic than your larger companies in terms of the outlook for growth. So that was something that I noticed as we went through the poll questions.
And how do you feel about international equity these days? Seems like it never can do any better than the U.S., and the U.S. has outperformed for so long. Is it finally time for international, and if so, where? Yeah,
we've maintained an exposure to international and recently increased it a little bit. So the big wild card in international equity investing is the U.S. dollar. And over the last few months or a year, you've started to see some weakness there. A lot of forecasts that maybe we're finally now, after years of strength, seeing U.S. dollar weakness. And that's supportive for your international equity returns. To a certain extent, though, your currency argument is which countries are doing better, and Europe's under a lot of pressure, and so it's not as clear-cut to us as saying we think the U.S. dollar is going to be weak. What we like there, we like emerging markets. That's the area that we added to. So you have better growth prospects in Asia and parts of South America, as well as Eastern Europe, and so that's an interesting area to us. It's kind of a combination. There's a lot of technology in emerging markets from China, South Korea, Taiwan, but there's also some commodity or more basic cyclical exposure, as well as a rising middle class. So you also get some consumer cyclicality. And so that's an area that we like. It's been working over the last few months, including this year. So I think those years of international returns lagging so much, the U.S. market, especially the S&P 500 and large cap stocks, on the growth side are behind us. And so having an allocation, and specifically within emerging markets, as well as we do like a U.S. small and mid cap, or international small and mid cap area.
What about on the commodity side? With inflation increasing, is it time to get into commodities, and will that be impactful, or will that have an impact on economic activity?
Yeah, we would put commodities in the alternative area. They have increased over the last 6 months. So you have seen rebound. Oil prices are above $50. That's good for parts of the FNBO footprint that are reliant on exploration. From that standpoint, it's tied into the recent weakness in the U.S. dollar. We're not at this point advocating a direct commodity exposure. In general, commodity prices have a lot of volatility with not much return. So it's an asset class that you had better be right with your tactical approach to commodities, because it's historically, meant lower returns or negative returns with a lot of risk standpoint. I do know that for some of our individual stock strategies that are buying companies, they have added to energy. So that was the worst performing area last year for really much of the last 5 to 10 years. And so we think it's at levels that are more interesting from a valuation standpoint. So we have seen some of our individual stocks go into, and we would assume that your value-oriented managers that we hold for mutual fund portfolios have likely also increased exposure to energy.
That kind of ties into another question we have. Is it time to buy some of the beaten up stuff like cruise lines, airlines, energy?
We've been doing a little bit of that, yes. That's, having a little bit more of a value bias, I think makes sense because of that cyclicality. They're also, that haves versus have-nots or post-vaccine second half. The market usually moves 6 months in advance of those economic rebounds in those sectors. I think it's still a point to be careful, though. So you want to own the best companies in that, so not the most leveraged, or riskiest companies within some of those beat down sectors. But cyclicals versus defensive, even with the recent rally in cyclical stocks, and defensive just is, consumer staples and utilities and telecom and parts of healthcare versus that cyclical industrials, energy, consumer discretionary, standpoint. So yeah, we do favor the cyclical, more value-oriented areas. That's where we've been adding over the last few months. At the end of the day, we're not ready to call an end to the technology. We're shortly getting into earnings season. The banks have reported, but now you're going to start to broaden that out. And as what we've seen in the third quarter is there's areas within technology that we think are going to report very strong earnings. So it's not a dump all tech stocks to buy value. It's more at the margin. Yeah, I would say there's more opportunities in some of those beaten down sectors.
How about in financials, and particularly banking? Is there opportunity to do well if interest rates stay low?
Yeah, I mean, banks were also one of the worst performing areas last year, just because of the spread compression as interest rates moved to zero. So banks would benefit if you have a steepening of the yield curve. So short-term interest rates stay at zero, but long-term interest rates start to increase. And so, yeah, I would characterize that as part of that value cyclical trade. It's been interesting. So banks rely on the net interest margin, which is, really went down last year, but will likely stay flat or maybe, find a level and start to increase, but also credit and provisions. And what you haven't seen so far is a tremendous increase in delinquencies and defaults. So there were a lot of concerns around the downturn in the spring that spreads were going to blow out, that you're going to see a lot of provisioning needs. Banks were very aggressive in putting in provisions in the second quarter, but they've actually released some of those that maybe they put in, too much in reserves here in the second quarter. So the credit cycle has been interesting to watch because you've seen a little bit of stress, so spreads have come up a little bit, but not as much as the worst case fears, certainly last spring.
Well, I think that's all we have for questions. Any final comments?
No, appreciate everyone's attendance, your engagement in the questions. We will make this deck available after the presentation if you're interested in, and if you have any follow-up questions, please be in touch with us and we'll get those answered. So it felt good to write the 2021 Outlook and turn the page. I'm sure a lot of you are feeling the same. And so we're certainly hopeful that this year is better than last year. So thank you.
Thank you all, and we'll look forward to a great 2021.